Welcome to Pip Insight Macro, the economic calendar briefing for the daily Forex news. Today is the 14th of July, 2026. This session has 6 high-impact and 1 medium-impact releases coming up. Let's run through exactly what's on the calendar and what it means for the major currency pairs. Welcome back to Pip Insight Macro. I'm your host for today's daily Forex news. We've got 6 high-impact events on the calendar, and the yen pairs are absolutely front and center. Dollar yen, euro yen, pound yen, and Aussie yen will all be in focus as we navigate Japanese data releases and a key speech from BOE Governor Bailey. Stick around for the full breakdown. Here is the full economic calendar for the daily Forex news. We have 6 high-impact releases due this session. Let me walk you through each key event and what it could mean for the markets. Bank of England Governor Andrew Bailey is speaking today, and this is a high-impact event for sterling. Bailey's commentary on inflation, interest rates, and economic conditions can shift British pound volatility significantly across multiple pairs. Traders need to listen closely for any signals about the BOE's future policy direction. BOE governor speeches are crucial because Bailey is the head of the Bank of England and his words carry enormous weight for monetary policy expectations. The market listens intently for clues about interest rate decisions, inflation concerns, and the economic outlook, all of which directly influence how traders price in future rate changes. If Bailey sounds hawkish or suggests rates may stay higher for longer, that typically strengthens British pound as investors demand higher yields on pound-denominated assets. Conversely, dovish comments, suggesting rate cuts or economic weakness, tend to weaken sterling. The key is listening for any shift in tone from previous communications, even subtle language changes matter. Watch for specific mentions of inflation data, labor market resilience, and global economic risks, as these shape rate expectations. Price action traders should monitor British pound pairs for sudden spikes in volatility immediately following the speech, with potential for sharp directional moves that can persist for hours or even days depending on the strength of his message. We've got Core CPI month-over-month hitting the calendar today, and this is a major economic release that moves currency markets significantly. This is the inflation metric the Federal Reserve watches most closely because it strips out volatile food and energy prices to show us the real underlying price pressures in the economy. With inflation still a hot topic for policy decisions, today's number could shift US dollar sentiment across multiple pairs. Core CPI measures the monthly change in prices consumers pay for goods and services, excluding food and energy. It's the cleanest view of persistent inflation trends. This data is critical because the Fed uses it to calibrate interest rate decisions. Higher inflation typically supports a stronger dollar through higher rate expectations, while cooling inflation could ease pressure on the Fed and weaken the dollar. Today we're expecting 0.2% month-over-month, matching the previous print, so the question is whether we see a beat, a miss, or confirmation of that steady trend. A beat would suggest inflation is stickier than expected, likely supporting dollar strength and putting pressure on euro dollar and pound dollar as rate hike odds increase. A miss would signal disinflation, potentially weakening the dollar and lifting euro and sterling as markets recalibrate Fed policy expectations. Given recent economic data has been mixed, traders should watch for any shift in the momentum. Whether this holds steady or breaks trend will shape the broader US dollar narrative. Price action around 1.0800 in euro dollar and 1.2700 in pound dollar will be key technical levels to monitor post-release. Euro dollar and pound dollar are We're looking at Core CPI year-over-year data today, and this is a critical inflation report for the US dollar. The forecast is sitting at 2.8% versus the previous reading of 2.9%, which would signal a modest cooling in underlying price pressures. This number is absolutely essential for Forex traders because it directly influences Federal Reserve policy expectations and dollar strength across the board. Core CPI measures inflation excluding volatile food and energy prices, giving us the clearest picture of persistent, underlying inflation trends in the economy. This metric is the Fed's preferred inflation gauge, so it carries substantial weight in their interest rate decision-making process. If we see a beat above 2.8%, that suggests inflation is stickier than expected, which would likely support a stronger dollar as markets price in a hawkish Fed hold or extended rate pause. Conversely, a miss below forecast strengthens the case for rate cuts down the line, typically weighing on the dollar. Recent trend context matters here. We've seen inflation gradually moderate from its 2022 peaks, but progress has stalled somewhat in recent months, so traders will be watching for any surprise upside or downside to this disinflationary narrative. Watch for immediate volatility in the first 30 to 60 seconds post-release, with sustained directional moves likely if the surprise is significant enough to shift Fed rate cut expectations. Euro dollar and pound dollar are your top exposures here because are stronger than expected. We're tracking the monthly CPI released today, one of the most watched inflation gauges in the world. This data measures month-over-month changes in consumer prices across the US economy, and it's a critical input for Federal Reserve policy decisions. With expectations calling for a pullback to negative 0.1% from the previous 0.5% print, today's number could have major implications for dollar strength. Monthly CPI, or Consumer Price Index, tracks how prices change for everyday goods and services that American households actually buy. The Fed watches this metric religiously because it directly informs their interest rate decisions. Cooling inflation supports rate cuts, while sticky prices justify holding rates higher for longer. A beat, meaning inflation comes in hotter than the forecast of negative 0.1%, would likely strengthen the dollar because it signals persistent price pressures, keeping the Fed in a tightening bias. A miss to the downside, showing deflation stronger than expected, could weigh on the dollar as traders price in a more dovish Federation. We're coming off a 0.5% print last month, so we're already seeing a deceleration trend, which is what policymakers want to see. Watch for volatility spikes immediately after the release, particularly in the first 5 to 10 minutes, as algorithms and funds reprice their US dollar positions based on the outcome. Euro dollar and pound dollar are your... We've got a major economic release hitting today, the US Consumer Price Index year-over-year reading. This is one of the most closely watched inflation metrics in the world, and it directly influences Federal Reserve policy decisions and US dollar strength. With forecast expectations at 3.8% versus the previous 4.2%, markets are pricing in a meaningful slowdown in inflation. The CPI year-over-year measure tracks the percentage change in prices paid by consumers for goods and services compared to the same month last year. This data is absolutely critical because the Federal Reserve uses it as a primary guide for interest rate decisions. Higher inflation typically leads to rate hikes, while declining inflation can signal the end of a hiking cycle or the beginning of cuts. A beat above 3.8% could reignite rate hike expectations and strengthen the dollar as yields rise, while a miss below forecast suggests inflation is cooling faster than expected, potentially triggering dollar weakness as traders price in rate cuts. We've seen inflation trending downward from the 9.1% peak in mid-2022, so today's release will tell us whether that disinflationary trend is holding steady or accelerating. Watch for the breakdown between core inflation, which excludes volatile food and energy, as this is often what the Fed pays closest attention to. Key resistance and support levels will form quickly after the print, with volatility typically highest in the first 15 to 20 minutes of the release. Euro dollar and pound dollar are your top two pairs to monitor here, as both are direct dollar crosses that react inversely. Fed Chairman Warsh is taking the stand for congressional testimony today, and this is a high-impact event for currency traders. His comments on monetary policy, economic conditions, and the Fed's outlook can move markets instantly. We're watching for any signals that might shift expectations around interest rates and inflation fighting. Fed Chair testimony is one of the most direct ways the central bank communicates policy intentions to markets and Congress simultaneously. What Warsh says about the current economic trajectory, labor market strength, and inflation persistence will heavily influence how traders price in future rate decisions. A hawkish tone, suggesting rates need to stay higher longer, typically strengthens the dollar because it makes US dollar-denominated assets more attractive. Conversely, dovish comments about slowing growth or easing concerns can weigh on the dollar. Traders should listen carefully for specific language around restrictive policy, terminal rate expectations, and timeline for potential cuts. Watch for any shifts from previous Fed communications, as consistency breeds confidence while surprises trigger sharp repricing. Key price action zones will emerge within the first 30 minutes after testimony concludes as algo and institutional flows respond to the tone and substance of his remarks. Euro-dollar and dollar-yen are the most sensitive pairs here. Euro-dollar strengthens when the Bank of England Governor Andrew Bailey is speaking today, and this is a high-impact event for sterling. Bailey's commentary on inflation, interest rates, and economic conditions can shift British pound volatility significantly across multiple pairs. Traders need to listen closely for any signals about the BOE's future policy direction. BOE governor speeches are crucial because Bailey is the head of the Bank of England and his words carry enormous weight for monetary policy expectations. The market listens intently for clues about interest rate decisions, inflation concerns, and the economic outlook, all of which directly influence how traders price in future rate changes. If Bailey sounds hawkish or suggests rates may stay higher for longer, that typically strengthens British pound as investors demand higher yields on pound-denominated assets. Conversely, dovish comments, suggesting rate cuts or economic weakness, tend to weaken sterling. The key is listening for any shift in tone from previous communications, even subtle language changes matter. Watch for specific mentions of inflation data, labor market resilience, and global economic risks, as these shape rate expectations. Price action traders should monitor British pound pairs for sudden spikes in volatility immediately following the speech, with potential for sharp directional moves that can persist for hours or even days depending on the strength of his message. Japan's revised industrial production report just hit the wires, showing monthly growth holding steady at 0.5%. While this isn't a major market mover, it's still worth monitoring as it reflects the health of Japan's manufacturing sector. The revision came in line with expectations, no surprises here, which is exactly why we're calling this a low-impact event. Since the forecast and previous readings matched at 0.5%, traders won't see any new information to spark significant volatility. Expect modest reaction across the yen pairs, with most movement likely driven by broader market sentiment rather than this data point alone. Dollar-yen, we're looking at German wholesale price index data month on month, which measures inflation pressures at the producer level before goods reach consumers. It's a low-impact release, but it still gives us insight into where consumer inflation might be headed in the Eurozone. The forecast is calling for a 0.5% increase after the previous month's -0.6% decline, suggesting a modest bounce in wholesale prices. This is a relatively tame data point, so we shouldn't expect any dramatic fireworks in the euro, but it does contribute to the broader inflation narrative. Any significant deviation from the forecast could prompt a mild reaction, particularly if it influences expectations around ECB policy. We're tracking a French bank holiday today, which means financial markets in France will be closed for the session. While this is a scheduled closure rather than economic data, it can create some interesting trading dynamics across euro pairs. Bank holidays typically have a low impact on Forex markets since they're anticipated events, but they can reduce overall liquidity in the euro during French trading hours. This might lead to slightly wider spreads or reduced volume on euro pairs, though the effect is usually modest. Traders should simply be aware that participation from French institutions will be limited today. Euro-dollar is typically based on today's releases, the pairs most at risk of volatility this session are dollar-yen and euro-yen and pound-yen. Here is a breakdown of why each pair is in focus. That wraps up the complete daily Forex News economic calendar breakdown. The key theme today is yen pairs under pressure ahead of data and central bank signals. Keep a close eye on the release times, a surprise deviation from forecast is often where the real moves happen. This is educational content only. Trade safely and manage your risk. Thanks for watching today's daily Forex News with Pip Insight Macro. Don't forget to like and subscribe for more Forex analysis. Follow us on X at Forex Insight for real-time market insights.